So yeah, this came up at the last board meeting. So this is the Float Tank Association presentation on the employee retention tax credit. Scott is the guy who worked with the various True Rests and my dad to help us not just qualify for this, but really just apply for it. And he was a recommendation to us. So we trust his advice and we trust what he's got to say about this. And he's going to do his presentation on just what it's about, kind of give you some general information, and then we can get into more specifics afterwards and kind of run through any questions anyone has about their business if Scott has time. So Scott, we'll let you take it away.
Well, thank you. And I appreciate the opportunity to speak to the group. This is part of what we call our PBO Thought Leadership Series, where we try to present topics that we think will be appealing to businesses and cover a wide range of industries. So this is, ERTC is not industry specific. It applies to literally all employers in the United States. And that's a picture of what I look like, so you guys can see me. And then what we're going to do today is we're going to go over basically the background of where ERTC came from. An important question: are you an eligible employer? Once we determine you're an eligible employer, we kind of try to figure out how do you determine what your claim amount is. And then, of course, the most important question is how do you actually get it? So disclaimer, because the lawyers got the hold of the deck before I did. This is educational, and this is not a marketing pitch either. So just for people to know that this is not an infomercial. I want to give you guys enough information so that you can determine if you think you might be eligible or not. And then if you undertake to try to do this yourself, I probably wouldn't. But if you deal with outside professionals, you can be armed with enough information to make sure that they're giving you reasonably accurate information that makes sense to you guys. So the Employee Retention Tax Credit was created in the CARES Act, which was enacted on March 13th of 2020. The reason it hasn't gotten a lot of attention is because the CARES Act also created the PPP program. And in the initial CARES Act, it was basically, if you got a PPP loan, you could not avail yourself of the Employee Retention Tax Credit. And so there's still a lot of web pages out there that say if you borrowed for PPP, you can't get the ERTC. That's just not correct, because that changed on December 27th of 2020 when PPP2 came out. Again, because PPP2 was the big headline story, a lot of people overlooked ERTC, and it just kind of, it was under the radar. I think, Mandy mentioned Jim and True Rest. I mean, initially Jim really, we talked about it. He wanted some help filling out his PPP forgiveness forms, which is something we did, probably did several hundred of them. And then we kind of brought up the ERTC, and he said, oh, well, that sounds pretty interesting. And we looked it over, and he qualified. And I think Jim's already received all his refunds. Probably the biggest things about this that can be confusing is, even though it's called a tax credit, it is not a tax credit. It turns into a refund, and it has nothing to do with income tax. It has only to do with payroll tax. And in the IRS world, the term refundable means you can get back more than you put in. So much like the child care tax credit goes out to people who probably didn't pay any income tax, you will get your full claim, which can be as much as $26,000 an employee if you can qualify in all the time periods and subject to a few other things. Another thing that I think clients have found interesting, there is no application process for the Employee Retention Tax Credit. This isn't like you're applying for a loan. This is a claim on the federal government. There's no particular budget. Like PPP, there was like, $500 or $600 billion. And when the money ran out, the window was closed. This has it doesn't have the same kind of concept. It's basically, it's an open-ended checkbook as long as you qualify. So I want to talk a little bit about ERTC boiler rooms, which I will call Howard Mackler and refunds.com, because I hear that commercial probably 25 times a day on Fox Business. Basically, when you listen to these ads and they say so-and-so got me approved for a payroll tax refund, that is, I mean, that's a misleading statement, probably to the borderline of a lie. You don't apply, and there's not an approval process. When you make a claim, the IRS processes your claim, and they generally give you the money. I've only heard of 3 situations where the IRS basically decided to audit the claim before they made the payment. And that wasn't with my firm, that was with another firm. So I can't really speak to why those particular ones got flagged. I've heard another one of my friends has a firm and they've gone through 4 audits so far. Those were all after the people got the money. What I would encourage you is if you go with one of these places and you don't know who these people are, you just want to make sure that you have and maintain all the supporting documents on the claim. One of my friends has a company and he used a different firm to do his ERTC, and he got a 2-page report. And I asked him, I said, well, did they tell you why you were an eligible employer? And he says, I have no idea. I said, well, you understand that if you get an audit, that's going to be the first question. And if you can't answer it, they're going to tell you to pay the money back. So it's critically important that as you go through this stuff, you want to make sure that you have documentation and that you really understand why you're an eligible employer. And that also, just because you get a refund check does not mean your claim was approved, because as I said, there is no approval process. So getting that check does not mean the IRS cannot come back and decide to examine your return. Out of the, I'm thinking 500 or so that I've done to date, I have received 0 audit notifications on them. And I don't know if that's just because the IRS is really busy, or for some reason we're missing whatever their screening criteria is on audits. There doesn't seem to be a lot of visibility into how or why the IRS determines to audit or not audit particular things. So the overview is number one thing, and I'm just going to touch on these words, but if you have ownership in multiple businesses and or some of the owners of your business have ownerships in other businesses, you need to determine if you're part of a controlled group and or an affiliated services group. And that is not something that came out of the employee retention tax credit. And it's critically important that if you're part of a controlled group, that you know it, because it really affects benefit plan testing, specifically 401k and medical benefits. So, not to pick on Jim's example, but I think, and I want to say 5 or 6 entities, and because they had a high enough degree of common ownership, they were treated as a single employer for some of the ERTC testing. So being in a control group isn't bad or good. It's just something that you need to know, because the nightmare scenario is you're in a controlled group, you don't know it, and one of your companies that you're in the group with has a really nice 401k plan and the other one doesn't. And if the DOL comes in, you're going to have some problems. After we get to that, we're going to determine the period you were an eligible employer. There's 2 ways to become an eligible employer, and they are alternatives. One is called the gross receipts reduction, and the other is more than the nominal impact to the business caused by a U.S. governmental COVID order. We're going to spend a little time talking about that. Once you determine that you're an eligible employer and the period you're an eligible employer, then we determine what wages are eligible. And then we're going to talk about, were you a small employer or a large employer? And then we're going to basically determine the ERTC claim. So on the eligibility, the gross receipts reduction is for any quarter in 2020. If your receipts revenue is down 50% or more from the same quarter in 2019, you are eligible in that quarter. You'll also be eligible in the quarter following that quarter, but it's important to just figure out the first quarter you're eligible in, and then you can figure out subsequent quarter rules. In 2021, the law changed and the reduction is 20%. Where I've seen people on the do-it-yourself program go wrong is they have a high degree of tendency to compare their 2021 revenue to their 2020 revenue. All the comparisons are to the baseline in 2019. So you're always comparing your revenue in 2020 and 2021 to the same quarter in 2019. You may also use the prior quarter. So in the first quarter of 2021, if you had let's say you had a 19% reduction in the first quarter of 21, but a 21% reduction in the fourth quarter of 20, you would be qualified in the first quarter of 2021 based on using the prior quarter rule. Probably the most important thing and the most confusing thing to people can be the quarterly measurements are to be made on the same accounting method as your federal income tax accounting method. That can be extremely simple. It can be extremely not simple. Depends if you file your income taxes on cash and you keep your books on accrual, you would have to know how to make the conversions on a quarterly basis. The other thing is if you're on cash, there's something called the doctrine of constructive receipts that comes into play to make sure that you got the basically the cash receipts posted in the right quarter. My experience with what I would call smaller companies is the monthly cutoffs are probably not nearly as tight as the annual cutoffs. And people tend to take any accounting adjustments they need to make, and they tend to post them on 12/31, even though they may not relate to that period. So when I look at the revenue, if I see somebody looks like they're reasonably close to hitting those targets of 50 or 20, we start to take a look at the transactions that are right around the beginning and the end of the quarters, just to make sure that they're absolutely positively in the correct calendar quarter. And if they're not, we'll basically make adjustments to move them and then recompute the numbers. So it's important to consider the gross receipts and the facts and circumstances as alternative means for qualifying. And just because your revenue is not down the required 50% or 20% does not mean you may not qualify. And you also need to evaluate every quarter individually, because you can qualify in some quarters, you might not qualify in others. You can qualify in a quarter on revenue for one quarter, facts and circumstances in a different quarter. So really the IRS looks at this quarter by quarter by quarter. And when we file the claims, we file actually a different claim for every calendar quarter. So the facts and circumstances route is described in the IRS Notice 2021-20, and I'll be happy to provide that to our hosts so that people that want to read it can. It's about 100 and some odd PDF pages. And if you can't sleep, this will solve that problem for you pretty quickly. Basically, the facts and circumstances have to stem from U.S. governmental orders. And a U.S. governmental order doesn't mean a federal government order necessarily. It means a federal order, an agency order. It can mean a state. It can mean a local municipality. It's basically a governmental unit that has the authority to compel you to do something or not do something. Interestingly, in these governmental orders, you don't have to be following them. They just have to be in place. And the agency doesn't have to be enforcing them. The orders just have to be in place. So there's a lot of restaurants that when, Closure 2 came by and they were not supposed to have indoor dining, we all know they did have indoor dining, but there was that order, and that's the order they're relying on to claim facts and circumstances for that particular point in time. These orders are to be orders that limit commerce, travel, or group meetings, and then it's for commercial, social, religious, or other purposes, and they relate to the suspension of an employer's business or its trade. So what that basically translates to, and I'll pick on restaurants because they're probably the easiest to understand, is when indoor dining was shut down and restaurants decided to take over the parking lot, sidewalk, DoorDash, Uber Eats, the delivery, their revenue in a lot of cases, not only did it not go down, it went up. But because indoor dining was more than a nominal portion of their business, and that order suspended that portion of their business, they were eligible to claim the employee retention tax credit, because again, this facts and circumstances route is completely independent from the revenue reduction. On the medical front, we have, we've got some, psychiatry groups where they couldn't meet the patients in person. And so they had to meet them like remotely, and obviously they couldn't meet them outside because, of HIPAA regulations. And, the analogy there is that if indoor dining is an outdoor dining, I think, in-person counseling and remote counseling that's not the same business. And it's the same for schools. It's anything where you'd have a situation where you used to be open, without appointments, and now you have to have appointments. So we basically look at, say, how did this impact the business? Not necessarily just the revenue, but actually, did it change the nature of the service and the economic utility? The IRS has said the impact is to be more than nominal. The IRS guidance says more than nominal means 10% of the 2019 revenue is in that segment. So that doesn't necessarily mean that segment's down. It just means that that's an impacted segment that was more than 10% of your business. One of the, a good example is a retail store that basically didn't have e-commerce, and then they decided that they pivoted to e-commerce. I had a client the other day, they do running events, and when basically every running event got canceled, they went to virtual events. And so their revenue actually was pretty stable, but because live events were more than 10% of their revenue, because it was 100% of their revenue, They're filing on the facts and circumstances position. Probably one of the biggest areas that I've seen confusion on is supply chain disruptions. Yes, there were supply chain disruptions. There's no doubt about it. I have seen very few supply chain disruptions that were caused by a U.S. governmental order. China shutting down is not a U.S. governmental order. 300 ships circling Long Beach is not because of a U.S. governmental order. It was because of a labor shortage at the port. So if we're looking at the supply chain, which probably is not going to be applicable to you guys anyway in the nature, we just want to make sure that we can relate that to a U.S. governmental order that's creating the problem and not just excess demand. We think that when you go into the third quarter of 2021, it's going to be very difficult to make a facts and circumstances case. And again, not impossible, because some of the healthcare businesses we've seen, there were still orders that were from the health boards that applied to the practices. I know that the Dental Association insisted on maintaining social distancing even after all of the orders were lifted in the state of California. And that created, for one of my clients, basically they couldn't use 40% of their capacity because they couldn't get the 6-foot circle around the chairs without restricting the use of a few of them. And it's important to remember, if you qualify in a quarter in 2021 based on the gross receipts, you will automatically qualify for the subsequent quarter up to the third quarter of 2021. There was for a while a fourth quarter 2021 ERTC that was rescinded by the bipartisan infrastructure bill when Congress basically took that off the table and said, okay, we're not going to have the ERTC for the fourth quarter. Another big thing that, and probably none of you guys are going to be large employers, but just so you know what the rules are, if you had more than 100 full-time employees in 2019, you're a large employer. So basically what it says here is if you had less than 100, you're a small employer. And then in 2021, that full-time employee count goes to 500. Full-time here is based on 30 or more hours in a weekly pay period. And it's a calculation that I make. It's a pretty quick calculation. Obviously, if you had less than 100 employees in 2019, you're not going to have more than 100 full-time. So that's probably not going to be much of an issue for you guys. However, it's very significant, especially if you're in a control group where we have to add together 5, 6, 7, or 8, 9 people, because small employers who are eligible can claim all of the wages paid in an impacted period, even if the employers were providing services, which is code for working. Large employers, they're eligible, but they can only claim the wages of employees who are being paid but not working. I don't have too many of those situations. I think out of all the ones I've ever done for the large employers, there was one employer who was able to claim 3 weeks because they closed their facility because of COVID orders, and they just paid the people to stay home because they wanted them to be able to come back when those orders got lifted. So what if my business received a PPP loan? And again,
We've got a couple questions coming in. You want me to go ahead? I think if they're, about what you're just saying now, can we ask them now?
Sure.
All of this that you're talking about, does it also apply to nonprofits?
Yes.
Okay, beautiful.
501c6s though.
Well,
Just
I'm
to
not
confirm.
exactly sure I know what a 501c6 is, but if you have W-2 employees, it's hard to imagine that it wouldn't apply.
Cool, thank you.
What about anyone that was maybe under construction and really trying to get their business open, but because of this was delayed for about 6 months? If they didn't start paying their employees till the first quarter of 2021.
So that's going to fall under, and we've got a slide on that coming up, but it's going to be the startup recovery business. And so we'll touch on that in I think 1 or 2 more slides.
Okay, that's good for now. Thank you.
Okay. So the PPP and the ERTC intersection to determine eligible wages, I was one of those guys that really liked math, and so I liked finite math. And so, I find these allocations to be totally fascinating. Most of my clients would be happy not to do them. But basically, what happens with ERTC is you cannot use the same dollar of wage that you got PPP forgiveness on to make an ERTC wage claim. And in the same way, if you got any sick pay reimbursements on the FFCRA, those wages have to be eliminated. The smaller categories are R&D wages to some extent maybe have to be disallowed. And then also federal work opportunity tax credits. Again, out of the 500 I've seen, the amount of deductions we've made for everything but PPP and to some extent sick on the bigger employers has been pretty small. The PPP loans under $150,000, you guys that had those, everybody filled out probably the form 3508S. It probably took, I don't know, 5 minutes to find the login and 3 seconds to click the forgiveness box. And it didn't require you to submit documentation. But if you're going to get the ERTC, we're still going to have to go through the process of figuring out what wages you actually claimed for your PPP forgiveness, just so they can be excluded from the eligible wages for ERTC purposes. So the way you claim the ERTC is amended payroll tax returns are filed for each quarter, except that the first quarter is filed on the second quarter form for 2020. If you guys, any of you guys are in a PEO, I would definitely encourage you to start the process to talk to your PEO. I will just say this, the PEOs have been very helpful. It's an extremely lengthy process with a PEO. As hard as it is to get information out of the IRS as to what's going on, it's even harder to get it out of the PEO. I was talking to TriNet, I think yesterday, and they're one of the larger PEOs. They basically said, hey, they're probably not gonna file the 2020 ERTC claims for their clients until June of this year. And so that means that a TriNet client is not going to see the money on their 2020 ERTC probably until the middle of 2024, if they're lucky, and the 21s are going to come in 2025. The PEO.
Can you clarify what a PEO is?
Sure. PEO means professional employer organization. And so, the big ones would be TriNet, Inspirity, Paychex / Oasis, and then ADP Total Source. And this is basically where those employees are not your employees and they're not their employees. They're kind of like both of your employees. So if you're in a PEO, you won't have your own 941s, for instance, and all your benefits are generally going to be coordinated by the PEO. So I don't know if that's prevalent in your industry or not. There seems to be some companies or some industries that are a lot more likely to use PEOs than not. But it's just that if you're in a PEO, you definitely want to know that, and you want to get in front of that PEO process right away, because the PEO projects probably take me 4 to 5 times longer to complete than the non-PEOs, just because of working with the PEO.
Got it. Thank you.
So as I said, the claims are made by filing a 941X. The refunds have been taking anywhere from 16 weeks to in excess of 1 year. I had a client that she got her, I don't know, $2.2 million this week. And those were 2 claims we filed back in December of 2021. So it took just shy of 14 months for her to get the money. Interestingly, the 941X is a paper form. What fascinates clients is, despite the fact that we have all this documentation and we point out our facts and circumstances basis, and we basically get everything in order, you do not supply any supporting documentation with the claim form. The claim form is it's a 5-page, it's basically a data entry sheet, and it doesn't really say much except your name, the period, and this is your claim. The period of limitations to make a claim is 3 years from April of the year following the year the form relates to. So all of the 2020 returns have a statute date of April 15th of 2024, which is why the PEOs are trying to cut this off at June, is because they want to make sure they get everything in before the statute date. And the 2021 returns have a statute date April 15, 2025. Although the audit period for the third quarter of 2021 was extended to April 15th of 2027. And that was at the request of the IRS, who said they probably needed more time to audit these than just the normal 3 years. So you can already, kind of get the feeling the IRS is, as we all know, overwhelmed, understaffed, and they're using computer systems straight out of the 1970s. So the IRS has some issues.
Scott, is that getting worse as we go? Because I know after filing with you, we got our money in like 90 days.
Yeah, some people got it really fast, and we don't know why. But I've got a theory, and that is all these forms go to Ogden, Utah. And I think somebody bumped into a stack of mail and knocked it over, and they restacked it, and somehow yours got on top, because we cannot figure out why some claims go fast and some sit there for a year plus. There's nothing on the form that these guys can review. I mean, there's things they can do if they can cross coordinate some of their databases. They could, probably get an idea as to whether or not your revenue went down enough or not. But literally, if they have questions, they're going to have to ask. I think the backlog at the IRS logically is only going to go up for the next 4 to 5 months, because they are getting, I would say probably a 500 million ACA forms, who knows how many 1099s, but literally that could be, a billion plus 1099s. You're getting all the W-2s, the W-3s, the 941s, the 940s. And despite the fact that you hear they were hiring 87,000 field agents, I think the last I heard, maybe their headcount is neutral, that they've hired maybe 3,000 and lost about 3,000. So they're literally getting more work with less people. So
Yeah.
it's going to be a while. So this is actually on your question about a startup business. Any business that started operations on April 15th or later may be eligible and is likely eligible for the recovery startup. And when we say started, we mean commenced operations. So I had a restaurant that I think fits the same fact pattern as you were asking about. They basically started building this restaurant in 2019, and then COVID kind of hit, and they opened a year late. So even though they started building the restaurant, they didn't start operations until after February 2020. And then if your average annual revenue is less than $1 million in 2020, you can claim the ERTC, assuming you can't claim it for any other reason. And then the max claim is 50,000 for the third and the fourth quarter for 100,000 total. And this is the only claim process that's possible for the fourth quarter of 2021. One of the important things is that startup business, though, can't be a member of a controlled group, because if it's a member of a controlled group, its commencement date is going to be considered to be this commencement date of the controlled group, not of the business itself. And so a question that always comes up from clients, they ask me about income tax. So the first thing I tell them is income tax is not really my it's not my field of practice, but I am happy to give them the information that I know so they can have a robust discussion with their tax advisors. The IRS guidance that came out of this is that the ERTC creates an expense disallowance in which the year giving rise to the ERTC were paid. So that's a fancy way of saying that the 2020 ERTC should be an expense reduction on your 2020 tax return, and the 2021 should be an expense reduction in your 2021 tax return. So an expense disallowance increases taxable income or decreases loss. Obviously, if you guys are in pass-throughs and you're amending returns and you got a lot of members, there's a lot of work there to be done. Speaking only for California, ERTC is disregarded. California views this as a payroll tax matter for federal, and because federal income taxes aren't deductible to create California income, California said this isn't taxable. So other states, I think, for the most part, are following that line of thinking, but I'm not sure. So that's one of the things that when you talk to your CPA, if you're going to claim this, you want to make sure that you get that kind of squared away and that you got a clear path on it. The other tricky thing on the income tax is that the income tax returns also have statute of limitations. And so I've got plenty of clients who have said, you know what, I see this, I read it. I know there's a Supreme Court ruling that says there's no legal obligation to amend a tax return. And many of my clients have said, you know what, I'm not going to think about this until I actually have the money in my hand. Because if for some reason I amend my tax return and for some reason the IRS disallows the claim, and for some reason it's past my statute of limitations of my income tax return, I'm not going to be able to reverse that. And so I'm not going to report income until I got cash in fist. I think that's a pretty solid line of thinking. If I was doing it, that's probably what I would do personally, is I'd wait till I got the money and then I'd make an informed decision talking to my tax advisor. So the key takeaways, are you determine your gross receipt by calendar quarter to see if you qualify that way, because that's a mathematical test. If you don't meet that, then we start to look at facts and circumstances analysis to determine how you may or may not qualify. The reading on that again is in notice 2021-20. There's about 20 pages that deal with the facts and circumstances of governmental orders. It's not much. It doesn't address nearly every particular situation that could ever come up. You know, as I tell all my clients, I wish there was a book that you could just look up and say, oh, here's something, and it's either in or out. There's very little guidance. It's shifted over time, as you might imagine, as most of the stuff on this has. So it's kind of like the ultimate gray zone. And what I tell people is, you know, if you can, you know, if you think you got a story and we had a governmental order and we really believe there's an economic impact to the business, and you could see yourself telling that story to a tax court judge or to an IRS field examiner, and that more than 51 times out of 100, you kind of get your way, I'd be more inclined to file than not file. But the other thing I always tell my clients is, the filing position belongs to the client signing the return. And the most important thing for the projects I work on is I want to make sure the clients have their eyes wide open as to the pros, the cons. Obviously, if you're qualifying on a revenue reduction, there's not much to say because it's math. The facts and circumstances, again, a little more in the gray zone. Claims under $200,000 are not currently getting the same level of scrutiny that the ones over 200,000 are, from everything we've heard from the IRS. That doesn't mean you should roll the dice and play audit lotto, but at the same token, with 13 million PPP borrowers and a few quarters for each potential PPP borrower, you can pretty quickly get up to the IRS is going to get 50 million of these claims or more. The IRS typically audits 0.5% of personal income tax returns a year and 1% of corporate income taxes a year. So, you know, it's kind of like, I like to tell people with Powerball, I'm not saying you should or shouldn't play Powerball, but I think it's important to know what the odds are so that you can actually say, okay, well, how do I really feel about this? The detailed payroll analysis is necessary to make sure that we're not double dipping and counting wages that were funded by other things, like mainly PPP and the Corona-19 sick pay, FFCRA. And then we have to cap the wages to 10,000 in 2020 or 10,000 a quarter in 2021. And then we basically claim it on Form 941X for each quarter, or we coordinate with our PEO and fill out their questionnaire and paste all of our analysis into their templates so they can turn around and process the claim on your behalf. The other thing that we did note on this with one PEO, just so everybody knows, the IRS also adds interest to these claims. And the interest is from the date of the quarter that's being claimed, the original due date, to the date the IRS processes the claim. So as we're getting now that some of these claims, the interest period could be easily, you know, 1+ year. In some cases, the interest is getting to be, you know, is increasing the claim by 10, 11, 12%. And that's obviously only going to increase over time. If you're with a PEO, you want to make sure that that PEO knows that you know that there's interest added, because we did have one PEO who did pay my client. And I said, hey, where's the interest? And they said, there isn't any. And I said, well, what do you mean there isn't any? And they said, well, there isn't any. And I said, well, that's interesting because I know there is. And I said, are you saying that the IRS didn't give you interest, or are you saying you're just keeping the client's interest income and not giving it to the client? Anyway, they kind of said, oh, we must have overlooked that. And my client did get their interest income. So, you know, just kind of out there, just in case, because there's people that, you know, they see money and they see people who probably don't know there's interest, and there seems to be some opportunity there. And that's it.
Awesome. Thanks, Scott. One of the questions that came up twice while you were just presenting is, you know, over this period, if someone sold their business and let's say no one's applied for this credit yet at all, can they still go back and apply? And can the new owner do it? Does the old owner have to do that, or how does it work?
Well, so the answer on that is going to depend on the nature of the sale. If it was a stock sale, then the current owner would be able to apply because it has the same EIN number. And if it was an asset sale, the old owner can apply, assuming they can still cash the check. and we've had this come up, you know, you were in the process of reviewing how to do this. Logically, there's no reason that even if the business went out of business, there's no reason they couldn't apply for the prior quarters because it's based on the wages that you paid in those particular time periods.
Okay. And then I'll let everyone kind of take themselves off mute so they can ask their own questions. But before I open it all up, I know you said it's not a, you know, a sales pitch here, but in theory, if someone did want to work with you, I want to clarify and correct me if I'm wrong, that when they do this with you, it's no money up front to even start this process because it is obviously a lot of work, but then they are paying a commission on the back end. Is that right?
Yeah, we have a success fee, and it ranges from, you know, 10 to 12.5%. The smaller clients tend to be at the higher end, the larger clients at the lower end. That's just really to kind of say, hey, that you know, at some point the size of the client doesn't overly affect the amount of the work. There's, you know, nobody pays until they actually collect their refund, and we also do not apply the fee to the interest income. I want the clients to have 100% of the interest income, and we know that if we take a project on today, they may not see money for a year. They may see it sooner, may see it later. It's not a problem. You know, we get it.
Okay, great. So we'll make sure that your information's out there, and there's no limit to how many clients you're willing to take at this point, right?
Yeah, the only limitation is I've only got till April 15th to get the 2021s processed, but other than that,
Okay.
no, there's no problems.
Okay, beautiful. Then we'll make sure everyone has your information, and we'll open it up to questions if anyone else has something specific they want to ask Scott. It looks like one came in through the chat. Can you clarify the qualification test of revenue deduction? It was reduction greater than 50% and then later changed to 70%. Does that 70% apply back to Q1 2020 or only when the 70% was enacted?
So for 2020, the reduction in revenue is 50% in a quarter. And then in 2021, the reduction is 20%. The 70% is the amount of the credit you get on the wage. That's not the revenue reduction.
Okay. Another question came in. You know, obviously you're super savvy on this, and I think that maybe the CPA that we normally use did not have all of this information. Is this something that's like now generally known by CPAs, or is this like a specialty that you have?
Well, you know, outside of reading, you know, 10,000 pages of legislation and doing 500 or 600 of them, you know, I think what happens with the CPAs is most CPAs don't do payroll taxes, because that's usually done by the payroll companies. And so you get a lot of CPAs that they don't have time to study the rules. And I think that they just don't want to undertake doing these for the most part. I've also seen, you know, and I've fixed projects for other clients where, you know, some CPAs have done them, and they took kind of a, you know, a strange approach to allocating the PPP wages, and they excluded all of the wages paid during the PPP covered period, even though there was a substantial portion of those that weren't forgiven. And I've had scenarios where, you know, the CPA would have left 300,000+ on the table for a client. So I think that it's like a lot of things when you're talking about something like this, where it's, you know, in the accounting world, this is relatively new, and it's also not going to last forever. So there's not many people who are going to be willing to try to figure out how to do it at this point in time. You just want to work with somebody who's done a few, and that, you know, you can get some kind of a reference on, or at least feel that they're not just going to claim whatever they can claim. Because my concern with the boiler rooms is just like much like the R&D tax credit was back in the 80s. My concern would be you get somebody, they go in there, they claim the maximum amount they can claim, whether you're an eligible employer or not. You get the money, they get their fee, and then you get an audit notification, and good luck finding those guys, because you're not going to find them. That's the risk.
Okay. And this question came up before we got started, but if someone already went through this process, tried it on their own, and maybe thinks there's more that could have been done, is it too late, or can they go back and amend any of that information?
Yeah, we've gone back and where somebody submitted a claim and the claim was too low. And we just basically, we recalculate the claim and then we file a second amendment, a second 941X. And,
Okay.
obviously the audit risk, there's at least potentially in my mind, a little higher, just because the IRS is probably gonna say, well, what's going on here? But the IRS also probably understands that people are scrambling to fill these forms out, and not everybody has ever filled out a 941X. And I've seen plenty that were filled out incorrectly. Just like I've seen plenty of PPP loan applications that were filled out incorrectly. And you do the best you can, but there's no problem to go back and reclaim the difference.
Okay. Yeah, and from a testimonial point of view, this came up at our board meeting, but from a True Rest perspective, I mean, all of our locations are independently owned and operated. They're all separate LLCs. They have separate partners, separate owners. So we do not apply any differently than any single one of you would. And for each individual location, we at least were able to get tens of thousands of dollars back for each and every location that we applied for, unrelated to the corporate business altogether. I just mean the individual storefronts. So I definitely recommend reaching out to Scott. And Scott, if someone did want to come to you and they're taking all this information in, they want to go do some work right now, is there any kind of documentation you want them to come to the table with when they schedule these meetings? Or do you have a template somewhere where they can go through and kind of start checking off documents to have a thorough conversation with you?
We do. We've got a checklist of the needed documents, and I can send that over to you guys, and then you can pass it out. The good news is you don't need any documents you don't already have. And if you don't have the documents that are on the list, you should probably call me right away, because that's probably a problem. Now, sometimes figuring out how to access those documents, especially the payroll data, if you're not used to downloading payroll data to Excel or whatnot, what we do is I have one of my technical assistants Zoom in with whoever is doing your payroll so that we get the report right in the first place. And we don't drive each other crazy with sending the wrong information. But usually I find people can collect the documents in 30 minutes or less on this.
Great.
And then the wild card again, if anybody's in the PEO, you just want to be up and front and center on the PEO, because we would also want to talk to the PEO before we even started to collect the documents to see what they're going to ask for, because they have asked for things that aren't necessarily things that I would normally ask for. I don't know why they want them, but basically, if you want your claim, you're going to do whatever they tell you to do, or they're not going to process it.
Right. Okay.
So I wanted to ask a quick question about the question I had from before. And that was, we're essentially a S Corp, and we were kind of investigating, trying to figure out if we were showing that 50% loss from 2019. And obviously I was one of those people that was like, oh, I look at 2021 and I look back at 2020. So I have no idea. And it doesn't look like we were eligible. But what surprises me, seems like there's other options that we can take into account. Maybe you could speak a little bit to that circumstance.
Sure. So the first point, whether a company is an S Corp, an LLC, a C Corp, partnership, that really doesn't have any bearing on the whole program. The only time I do tell clients, if they're in LLCs and they're being taxed as a partnership, I do tell the owners they probably shouldn't be on payroll, because that's a different problem, just to kind of give them a heads up on that. But then in terms of if clients don't meet the revenue reduction criteria, we start to look at the implication of facts and circumstances. And again, I think, restaurants are probably the classic. I've got optometry practices where some of the locations were inside shopping centers and some weren't. So they had, multiple locations, and the shopping centers were closed. So even though their revenue didn't decline by the 50%, the fact that their shopping centers were closed is a significant impact to the business for the period during which the shopping centers were closed, and or the hours were significantly curtailed. So it's really looking at that notice 2021-20. And Mandy, I'll send you the subset of it that relates just to this so that people can read it, because it gives you a flavor. And I tell people is you kind of have to put on your economic hat and say, is there something bad that happened to my business economically, whether it be I didn't grow as fast as I probably could have because I couldn't go to trade shows, I couldn't go to meetings, I couldn't travel, whatever, or I couldn't get foot traffic in because my doors were closed and I had to go to remote. And then once you say that, I say, okay, now can you relate that to a governmental order? So, things, there's some things that are simple like churches. The churches were told you can't have indoor worship services. So they went to, live stream and outside. And of course, their contribution stayed relatively level. And that's considered to be an impact on their capacity, and they're eligible based on that particular order that basically said you can't use your building.
So it's essentially like the potential for there to be a loss.
Yeah, or I would say an impact.
Okay.
And just not to kind of bore people with constitutional law principles, but basically the ERTC emanates from the Fifth Amendment to the U.S. Constitution, the taking clause, which basically says the U.S. government is not allowed to take something from a private citizen without adequate compensation. And basically, when the government put in these orders, what they took from private business was your ability to operate as a free enterprise.
Okay. And I think this was asked, but we just recently sold another business that's not a float center, but we still should be able to apply because we took PPP money for both of the entities. So it seems rather complicated, but that's actually why, that's one of the services you offer, right, Scott? And also just to clarify, Mandy, you can personally attest for Scott here because you utilized his services.
Mm-hmm. Yeah. Yeah. And I think what he's talking to in terms of like churches or restaurants and whatnot that it could apply to us specifically is, we increased our time between floats from 30 minutes to an hour. That gave us more time to clean, more time for hydrogen peroxide to sit there. That impacted the way I was able to do business, the amount of new clients I was able to see. We shut down all day Mondays, to do extra cleaning. Obviously couldn't go to trade shows, couldn't go, do any of those kind of events that I would have normally done. So all of that is a direct impact, completely unrelated to whether or not the revenue went up or down.
So it's like a critical thinking exercise, and Scott, it seems, has expertise in specifically the float industry. So it might be worth anybody who needs a little bit of help with this to reach out to him.
I have a question.
Hello.
Hello, I have a question.
Yes.
So we're talking about looking at either the income reduction, and that is quarter by quarter. And then we're looking at the potential facts and circumstances. Is that quarter by quarter? And then
I would say on the facts and circumstances, it's not really just quarter by quarter. It's basically the timeline of a specific order. So for instance, almost all of the orders in California were lifted on June 15th of 2021. So if a client's impacted in the second quarter, we only trim their payroll through check dates through 6/15, which obviously is almost the whole quarter. But there's been some scenarios where clients were subject to a 3-week something or other, like in San Francisco. So when we look at those orders, we look at the specific timeline the orders were in effect.
Okay. And then when we take a look at the quarters, whether it's facts and circumstances or by monetary revenue reduction, how do you figure what your refund is?
Well, we run the wages, and then we allocate the wages that were paid in the quarter. We subtract the PPP wages. We cap the wages to 10,000 for 2020 through the various quarters you might be eligible. But so in 2020, the maximum amount you can get for any one employee is $5,000. So if you have 10 employees, you could have a 2020 claim of 50,000. Now, if you have 10 employees, but you turned over a few employees, so that actually during the course of the year, you only had 10 average employees, but you actually paid 13, you might be able to get 13 times 5,000. And then when we get into 2021, the program gets better because the 10,000 cap is per quarter, and the max per quarter that you can get a refund, you can get $7,000 per employee. So you can kind of see if you got a scenario where you've got 10 employees and you could be in all quarters, you have a potential claim there of $260,000 or potentially even more than that with turnover.
Okay.
And so, and I know, Amanda was talking about, claims in the tens of thousands, and there certainly are plenty of them. We've had claims in the, north of $8-9 million too, with people that have had hundreds of employees. And yes, I have seen the refund checks, because the client was so happy, they scanned it over to me just so I could see it. And I knew it was a refund because it had the Statue of Liberty on the left and a big number on the right.
Okay.
Any other
So-
questions for Scott?
I have a question.
Yeah.
Hi, Scott. Thanks for all that information. That's great. So I think I went with one of those bogus companies because they took a big cut of what they said I was entitled to. And I didn't get nearly the amounts that you're talking about. Now it's me, as the sole business owner. I had like 3 employees at the time in 2019, and then they all left and it was just me in 2020. So I'm not sure which quarters I should be comparing.
Well, so again, if you're qualifying on revenue, you're looking at your 2020 versus your 2019 and your 2021 versus your 2019. Then you're looking at the actual employees on payroll. And so if you were the only W-2 employee, literally if they were following the IRS guidance to the black letter of the law, majority owner wages are not eligible. So you would have no eligible wages.
Okay.
Now I've had plenty of clients who have said they completely disagree with the IRS's interpretation on majority owner wages not being eligible. And they point to the legislative intent of Congress, and that when Congress extended ERTC to PPP borrowers, we know PPP borrowers are a small business because that's the definition that big business couldn't get PPP loans. And we also know that small business is family business. So their point is, hey, to extend this to small business and then turn around and say, oh, by the way, working owners and working family members can't claim that they disagree with that view. And they understand that, and they say, I'm claiming my wages, and I'm more than happy to stand up and tell the judge, this is why I did it. So, okay. The most important thing to me, though, is that if they claimed your wages, they should have told you.
Yeah. So I guess two little questions right now. So am I eligible to reapply? And the trade show issue with the non-wage piece of it is like, if trade shows weren't actually happening, my inability to attend them really is a moot point.
Well,
So how does that
the
factor
trade
in?
shows weren't happening because they were canceled by governmental order, though.
Right, so I couldn't have attended anyway. So
Right, but so what we did is like I got fashion clients, and Magic got canceled in Vegas. So when they can't go to Magic, that basically means they're not writing business for like the next year to any great extent, because the Magic, they used to write 80% of their orders at Magic. So the positioning there is that, hey, that trade show cancellation by the government is essentially interfering with their business.
okay.
So even though you could have gone, maybe you could have flown to Vegas, and maybe you could have pulled a slot machine lever, but there was no convention to go to.
Got it. Thank you.
Scott, I have a question regarding interaction of the credit and PPP. If we use PPP in part for owners' wages, non-W-2, I presume that would not be backed out of what we're eligible for the credit.
Yeah, if you applied some of your PPP loan to owner wages, and if we don't claim the owner wages, then it certainly wouldn't be backed out. So yeah, that sounds correct.
Okay, and then how can we maximize the amount of PPP that went towards owners' wages?
Well, we'd have to look at how you filled out your forgiveness form. To see what you actually put on it. And again, it depends if you're in a 3508S, there's a lot more flexibility because you didn't support any supporting documents. So we can really go back in and probably redistribute the wages to maximize the allocation to the owners. There's also on the 3508S, I find the form to be extremely prejudicial for ERTC purposes because there's nowhere to list your non-payroll expense. So most people that filled it out, if they got a $90,000 loan, they said, well, I used $90,000 on payroll. Well, that could be true, but maybe you used 40,000 on non-payroll, and we should allocate between the two categories like you would have done if you filled out a 3508S easy. So the first thing I look at is I say, does it make any difference how you filled out that form? In that, are you not able to maximize the ERTC because of the way you filled out your forgiveness form? And if you are, then we kind of have a discussion and say, okay, I saw one today that for whatever reason, the client decided to use a 9-week covered period because that's what she wanted to use. She should have used 24 weeks because by spreading those wages out, it led to a lot more wages being available for ERTC. So we're having a discussion and say, hey, you know, you can't really fix your forgiveness form, but you could probably say, well, you know what? I didn't fill it out as correctly as I could have. It's not going to affect your forgiveness. To say this is a gray area, it's an unexplored area because basically what the SBA has said is once your loan is forgiven, you can't amend your forgiveness form, which I don't know why anybody would want to amend their forgiveness form. So I do look at those, and we first figure out if there's really an impact with what we did, and then if there is an impact, how big is the impact, and what can we do about it, if anything.
Great, thanks.
All right, I think we have time for one last question, and then, you know, we'll definitely have all of this recorded and we'll be able to repost it with all of Scott's information. But does anyone have one last question before we close out for the day? All right, Scott, I think you just have everyone thinking.
Great. Well, good. And he said, if people have questions on the road, you know, just email them in. You know, we're happy to reply to them.
Yeah, I think you will. So we'll make sure, again, this is recorded, posted for everyone with Scott's information. And Scott, thank you so much for being with us. We appreciate you.
Thank you, and looking forward to speaking to some of you down the road.
All right, have a great day.
Thanks.